All right, good morning, gentlemen. We have Paul Jenkins and Scott Z here as for a free advanced coaching session for a better choice of words. We're going to go through a bunch of basics today on this first session. Today is September 2nd, 2017, approximately 10:17 a.m. Eastern Standard Time, and welcome. This is Clueless A Trading Frank, and session will be recorded. It'll be uploaded to the YouTube channel. It will be also categorized under new member introductory videos, which is pretty much what the beginner sessions are categorized. And I highly suggest that both of you, at your own time, sooner than later, review a bunch of those videos in there, especially a couple that I'm going to mention, which you guys need to look at. Those are very explanatory on chart patterns and things like that, which we are not we're not going to go into every single detail on the chart pattern stuff, but they're pretty easy. And I think they and that's really what plays out in the markets. And I kind of keep it as simple as possible. So those are all under new member introductory videos on my YouTube channel. There are different playlists. So good. Now, what we will do here today is, bear with me one second. I was looking for, okay, what we'll do here today is I need to basically get under the hood, for a better choice of words, and find out a couple of real important things, because a lot of the deficiencies that traders have, of course, we know the mental part and all that. It's real money at play. We know that. I go through it every single day. That's my living, and it's not, trust me, it doesn't feel that good during times of distress when we're buying things. And then, of course, the joys come when the market does exactly and then just ramps up. But anyway, that's a separate issue. First of all, what you guys are primarily, let me start one by one. Paul, when you're looking at things, are you primarily looking you're on a desktop, correct?
Yeah, I'm on a desktop.
You're on desktop. Good. Now, what platform are you using? Trading platform.
Thinkorswim.
Excellent. So that's a tick. It has to be a charting platform. More importantly, trading, you can put it wherever. You know what I'm saying? But you can put your trades wherever you want. But the charting platform has to mimic at least one or two of what I'm putting across. Simple logic. Then it kind of falls into place. So Thinkorswim you're using. From a do you and okay. Second question is Scott, what platform are you using?
And Thinkorswim also.
Okay. Are you guys at all using one of the simplest and most effective platforms that I personally use as a professional trader, too, which is investing.com?
No.
Okay, Paul?
No.
Okay, so we found the first deficiency. This is the simplest and the most powerful. Thinkorswim's fantastic. I mean, that's like driving, a rocket ship. There's stuff in there I don't even understand. But the thing is, this investing.com, this is free. I don't pay them. I get real-time data on this. I'm posting charts on this, as you guys know. I use 3 different platforms: Thinkorswim, investing.com, and of course the very advanced quad system, which I call the Algo HFT platform. You guys know that. And that's sort of, you guys should do a free trial on that. I've been using it for more than 12 years or more, and only in the past couple of years I've really used it effectively. And I'll send you guys the link. Call them up, do a free trial, and there's a whole video on that, how to set it up. But one thing at a time. So the investing.com, so first thing on your to-do list, and write it down somewhere or make a mental note, you got to use this. This will save you guys heartaches and give you a heck of a lot more money in your pocket between the reaction time, my alerts, and what I'm putting across and what I'm showing. This is the simplest chart that I'm showing you on the Russell 2000. On the Thinkorswim platform, I was extremely bullish on the Russell 2000 when every single voice out there, including the so-called gurus on Wall Street, telling us that the Russell 2000, and here I have no moving averages or anything. This is a plain old simple candle chart. Okay, on the Thinkorswim one, I kept on saying, as you guys know, and Paul, you have to get a chance to review it since the 18th, which was only a couple of days ago. The 18th was basically last Monday, and I'm sorry, the 18th was Friday, 2 Fridays ago, and that the Russell 2000 would bounce off and at least try to kiss the 34 and the 50-day moving average. And there was a lot of upside on that. Whether it fails there or not is not my concern. This move alone was almost 600%. I would say about 600. Yeah. No, I'm sorry, 460%. I think it was more because I took staggered profits. But here was 1350. I mean, this is the IWM, I'm sorry. Same thing. All right. The Russell 2000, which I'll show it to you on the other side. In fact, I'll show it to you right now on this side. There. Here was the daily chart that I kept on showing. Of course, the ones that I post on Twitter are heavily annotated with big fat arrows and stuff. You guys know that. So there was an arrow here. There was an arrow here. It was perfect pattern symmetry. It still is. It still is. And these were the two lines that were act as magnets. And we're going to talk about this tonight. Because like they say, it's the KISS principle. And at this juncture in the Russell 2000, this was a North Korean missile launch over Japan, all that stuff. And then this, which was on the 18th. I had drawn a line, same chart, there you go, since last November's election, since elections, okay, this is what it looked like. So every single voice out there was just like, that's it, the Russell 2000's gone, the US small cap growth, these guys are going to, they're going to fall below they were well below these lines, and that they were going to fall lower. I said, okay, great, we're risk traders here. I'm looking at things here which are showing me dramatic oversold conditions. I'll take a shot. Bought a little bit more here, and then the result of that, you could have bought something at $4. They were literally at between $24 and $28 by the time all said and done. And I'm serious. I mean, this is. I mean, the Russell 2000. Just so you guys know, and I'm highlighting it because I was very bullish on it, and I'm still bullish on it. But but technically speaking, it's getting overbought, so it's going to pull back a little bit, which is going to give another chance for people to buy it. So let me just go back. I'll get into the technicals in a second, but let me show you. So bottom line is investing.com. It's the most iOS friendly app. Many times, when I post these charts, I'm posting it directly off my iPhone if I'm off my desk. And when you scroll through it, you'll see it. I'm going to give you an example here on the Twitter feed. 1 second. Like early in the morning when I'm showing the futures chart, I am basically just running it off. Download the app. If you guys don't use this, you're doing yourself massive harm. Not because it is extremely powerful. The ticks are very visible, every single one of the candles, and each of these candles are basically the lifeline to happiness or heartbreak. So this is so definitely use that. Investing.com. Just sign in with your email, and that's it. Here was a chart that I had devised on this, going all the way back. Well, it goes all the way back, but this is from, let's say, for example, from the 27th of July. Seems like decades ago, right? With the volatility in the market. And here was a band that we were traveling in. This was the band that we were traveling in. Heavy volatility band, no question about it. Okay? But there was a band. There was a trading range here, and the trading range is signified in the form of these dark green lines, and then we overshot. I still remember that thing. We were just trading this band, and bang, it just went berserk. And not just went berserk. We knew it was going to happen. There was going to be a breakout, but it happened. That day. I believe it was a Friday, because they wait for Fridays generally. What was the 8th? Let me put a calendar up. The 8th was a Tuesday. This was a Tuesday move. So August 8th shot up, created a big fat reversal back into the band, and it started trading. Again, tried to go up and all that stuff. One of the big flash crashes, the big one, then a massive reversal. Same old story. Markets are not random, and I just want to make it very clear with both of you guys. And this is the reason why I survive, and I survive very well by trading my charts. And it is a bit of a learning curve, but you know what? It's not rocket science.
We're moving pretty soon to the game.
Can you somebody mute their mic a little bit? Hello?
Can you hear me?
Yeah, if there's a lot of noise in the background, just mute yourself for a second. Okay. So bottom line is, markets are not random. These markets are purely, I would say, 100% mathematical, algorithmic moves. There is no randomness to it. The volatility might seem random when you're looking at it in the microcosm of a certain day, but overall it's not. And whether or not what we think, what I think, what the world thinks, oh, this is going to take down the market, blah, 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 means nothing. And that's the reason why over the years, and more so now than ever, I'm as robotic as possible. Does it mean that I don't do stupid things? Sure I do, but my stupidity is much smaller than my tactical than my tactical moves. So bottom line is that's what I really try to teach and share. And more important than teaching and sharing, I mean, let's cut the crap out. It really doesn't matter what teaching and sharing. It's whether or not you're making money off what I'm seeing, and whether you're seeing the same thing, because that's going to help you stay within the trade and not bail out and then see the market roar as it has been, and sit there and feel like crap. Because look, let's face facts here. Nobody says, and I'm going to zoom in now. So anyway, we were. Let me just get back in this here. So we were in this band here, and what's going on? One second. Are you guys? One second. I don't know why I can't. That's strange. Are you guys there?
Yeah, I'm here.
Yeah, for some reason I can't use this thing. Why? Very strange, very strange. I need to use my pen. Okay, at least I can use this. What about this? Funny how it doesn't, normally I can write over this. Bear with me 1 second, guys. Can't even double click in there. But I'll just use this. This is good. That's a good pointer. All right. So go and all these things happen. A big, intense moves. Now let me just be very clear about this. These markets have become so mechanical that even, and this is something that should be a little bit of a consolation to a lot of retail traders, that even some of the best minds out there, and I know some of my ex-colleagues too who work for hedge funds, can't trade these markets. They just can't. And they can't seem to understand why things happen. And let them be. Because I'm not saying I can figure out every single move, but I've certainly figured out the directional move way too many times for me not to have enough confidence to project or forecast the next couple of moves, because I'm my biggest I am my biggest critic, and And I never sit back on my laurels and say, hey, I'm the best. I know everything what's going to happen in the market. Garbage. But I do know one thing, that as I've done this more and more, as I have benefited from these tactical charting more and more, I am getting better and better and better. I mean, I'm pinpointing levels, and this is not the first time, okay, where they're so precise, it's scary. Now, why? Because I know exactly what the points are? No, it's because the markets themselves have become completely mechanical. So when I'm drawing my lines, and that's where pattern recognition comes in. And keep in mind, I'm not trying to make you guys some PhD scientists on, like I've said, PhDs in advanced technical analysis. All I'm doing is showing you so that when you look at my stuff, you basically get maximum benefit out of it. That's all. I'm not asking you to construct charts. That's my job. And if somebody wants to do it, I have traders who have basically become fantastic technical chartists and trade some of their own stuff on their own using my methodology. And they have taken a whole bunch of advanced coaching sessions and stuff. I mean, they're good for them. But majority of traders basically want to rely on, which is normal, they want to rely on my alerts. Look at the visuals, see some of the changing conditions during the day, the volatility moves, okay, or intraday, but understand where the charts are going, because that's how I'm putting across, and either stick with the trade, because that's really what it's all about. It's leaving the trade, which is far more of a heartbreak than quickly taking a loss on something and being flexible. That's another topic that we have to discuss at maybe some other day, or if we have time today. But the bottom line is, at least to understand the messaging that I'm trying to show. So it's very simple, it's common sense, but I hope you guys understand what I just said, right?
Yes.
Okay, so because that's the most important part. I'm just trying to show what you need to look at, and how you manage it. That's going to come through, that's going to come through learning on the job, So that's a given. Nobody can teach a profession, somebody else's profession, in 2 minutes, or in a couple of hours. So bottom line is, what we are seeing on a broad scale here, and let me see. This is very strange why I don't have access to this pen. Okay, doesn't matter. We'll just do it. So bottom line here, you can clearly see all since the beginning of August, these big patterns, big fat patterns, quick, and when you look at a chart like this, you can pretty much clearly see, and I have shown all these little waypoints, okay, as to which, what's going to happen. This pattern is going to repeat itself again. Now, will it repeat itself all the way down here? I don't know. Do I think it can? Sure, it can. September generally, with a lot of these political gridlock going on with the debt ceiling, all kinds of stuff. September generally is a very volatile month. Good. We're ready for it because we know exactly what levels the market will fall. And this is a game of probability, obviously. High probability where the markets will fall, where they can bounce from. We know by now, after 3 massive multi-hundred point moves, okay, within the market, each of these are a couple of hundred points, right, on the Dow Jones Industrial Average, that this is a pure pattern symmetry. When I said the first pattern symmetry completion, that's what I meant. This one and this one. It overshot a little bit on Friday, but it was still within the level of this first pattern symmetry completion. The next one is obviously here, which is the highs on the market. Remember, these are the futures, so you're looking at 24.88, which was the last high, which was approximately, which translates into 24. Translates into 24.93. Remember, when I'm showing the E-minis or the ES charts, right? I'm not trying to make anybody a futures trader, but this is what drives the market. So if you understand what's happening on this stuff, or the stuff I'm putting through in the form of charts on the futures, you know how to handle your trades overall. So bottom line is, and both of you should write this down somewhere. When you're seeing 24.88, on the E-minis, how does it convert to the S&P 500? Because that's really what, everyone talks about. Do you guys know?
It,
All you do is add 5 to it, roughly 4 or 5
5.
points. Okay,
Yeah.
so 24.88 intraday, we were up to 24.93 and closed at 24.90.87 on on the SPX on that day, when we went up there at the beginning of August. So all you have to do is add 4 or 5 points to it quickly mentally on your head, so that's where you arrive on the S&P 500. Am I clear on that?
Yes.
Okay, great. So when you look at a broader picture, you can clearly see through all this intense volatility, and I'm not shying away from it. These are intense volatility. Each of these moves can be 50, 60 points, generally speaking. And here is another thing you guys need to write down. One S&P point is roughly about 6 Dow points. So when the S&P moves 1 point up or down, the Dow Jones Industrial Average will move roughly 5 or 6 points. So when you have a 10-point S&P, when you have a 10-point, this was a trading range, right? So this trading range was 2460. The high was 2480. How much was the Dow Jones Industrial Average moving on this when it was stuck within this trading range? This was a trading range that we followed for a while. There, see that right there, since the end of July. In fact, going all the way back. Yeah, because this chart is like a running tactical commentary on which people use pretty effectively. So this trading range that I showed way back, okay, was on the low end was 2460, on the upper end was 2480. That's 20 S&P points. So question to Paul. 20 S&P points is how much on the Dow Jones?
It'll be 5 times that.
Okay, so roughly 100 points. So we were moving between a 100-point band in the market, which was still freaking out retail traders. They're like, oh my God, it's the end of the world, But during the day when it's happening, individual stocks are obviously reacting a lot more. The volatility on individual equities is far more and it's not like the Dow Jones were moving 100 points every day. I'm just saying over a bunch of days, that's what it was stuck in until it broke out. So Scott, you got it, right? It basically you understand the trading bands as I show it on my charts.
I do.
Okay, and then the crash and burn comes. The Trump Economic Council resignation was here, and I can't remember. Was it on the 9th or was it the one on the? Because I think it was the 9th, because I made a lot because I went short. Because I said, this is obviously not market positive, blah, blah, blah. I don't remember my exact comments, but I made it very clear that that's not a good thing for the markets, period. No, it was here. That's when it was this move right there. And I didn't expect, look, I don't always expect, 300-point drops in markets. If I'm positioned the right way on certain hedges, then great. It's like the North Korea missile launch, I didn't expect the markets to, just have a this was the North Korea missile launch. Have a mini crash. Fine, happened. The VIX calls went up 400%. Sold them. It's just the way it is. You always got to have hedges. My new term is always being short. They're cheap. You got to put them down. You look at the P&L. They're actually red. Mine are red. I'm down about 30% plus on those VIX things. So what? That's insurance. Just in case anything happens, they'll be up 200% plus. So that's immaterial. I don't go all short, 100% on my trading book. Never. Because that's like, that's nuts. Because when everyone thinks like, it's the end of the world, just as they did with the Russell 2000 or with the S&P 500 at these tactical lows, you know what they do. Don't forget, we're in a very powerful bull market, and the corrective actions are going to be fast and furious. And what I do very effectively is show the levels where we can drop and so you know pretty much where you truly need to panic or what's going on. This market's not breaking. If they have a major credit crisis, we have a constitutional crisis, short term it will. Then it's going to pick up and run, because the key thing that that I would say a majority, and this includes Wall Street. Wall Street's not bullish on the stock market. Read around the articles. They're all pretty much bearish. And I'm an product of ex Wall Street, okay? And I know these guys are not. They still haven't readjusted their expectations for the year. Now I'm not super bullish, but what I'll tell you is overall the general fundamentals on the market, and which is really earnings, I mean pretty goddamn good, and global earnings are pretty strong. So bottom line is, what gives? So if you have that high level of pessimism coming all the way from institutional traders to retail human traders who are always panicking on any small drop in the market because they're going by the numbers, they're not going by the technical picture, or the tactical picture as I like to call it. Those are two great ingredients for the markets to continue through corrective waves, go higher. We're not on the verge of a recession. We don't have a credit crisis. When the Federal Reserve starts to really ramp up rates, that's the first sign that the markets are going to. And I'm talking after the fourth rate. That's another day's story. After the fourth rate hike, and if there's an acceleration on the general federal funds rate and the general interest rates on the 10-year bond, that's when markets freak out. It's really as simple as that. They don't freak out, but they start to ease back. Anyway, going back to this, when ranges break and then this volatility occurs, there's a lot of stuff in here, which obviously, you listen to my other video casts and stuff. There's a lot of patterns being played, a lot of candle dynamics, which reminds me, there's a fantastic video that I found on Pinterest, actually, and I put it out there. I want you guys to listen to it. It's 15 minutes long. It's fantastic. It's one of those robotic voices explaining candlesticks. Candles make me a lot of money. Candles make traders a lot of money. You don't need lines. You don't need anything. I mean, honestly. But what I do is I structure the volatility in the form of the different levels and, of course, larger patterns that are played out. These are very large patterns of big cup and handle type of moves, big cups. But bottom line is that you can just trade off candles. When I'm showing stuff, and if let's say you bought some SPX calls or puts or whatever the case, these candles are your lifeline, because they are within a matter of minutes when something like this happens. Okay, this was early in the morning, and then just the berserk, these candles. You can manage your trade. You can see what's going on. Is it easy? For me, it is. For you guys, it's not rocket science. You'll get it. The massive and on top of that, I'm constantly posting. I think I post more actual, I mean, not I think, I know, real-time dynamics on the market, and with explanations in most cases of what is going on, so people can stick with their trades, than anybody else out there. And it's second nature to me. Some people say, why do you do it? You just show the charts and say, fine, let people do what they need to do. Some traders have told me that, because it takes a lot of time out of my hands, which is fine with me. But so if we had, let's say, in a trade, and you didn't get it down here, you got in here, let's say, sorry, this was during the day, so let's go back to 10 o'clock. So let's say you got in here, you're getting the ramp up. This was a full day ramp up, actually, because it kept on going all the way till the close. But let me find another example. Let's say, here's another example. Market opens, big fat ramp up. You decide, not decide, whatever reason, whatever. I'm going to use the word you decide to basically come in here. It's hitting the lower end of this range that we broke, which is going to be resistance. I already have an arrow there. I'm out of it, out of the trade, probably at these levels, because I don't wait till the last minute. Sometimes I do. I'll let the runners run, like Priceline. I had like one call left. I just said, go with it. And that was the one which reached Mars. So bottom line is that that right there is a big fat arrow. Are you going to respect that arrow? Yes, you will. Because I didn't put that arrow there to make the chart look pretty. I did it because that's going to be a formidable resistance. That's exactly what happened. That formidable resistance didn't create a crash, but it could have. It just created a pullback. Thursday, right? Thursday. This was Wednesday. So Wednesday created a pullback. Strong market. They wanted to take this markets higher. This impulse wave. These are known as impulse waves. This is a massive impulse wave. Also in my videos, if you listen, I mention, I've seen this happen a lot. Never really. Hedges are fine. Those are insurance from putting away. But never actively short the market on Labor Day weekend. Never short the market on Thanksgiving. Never short the market right before Christmas. I'm talking the week before that. There is a underlying propensity for the markets to go higher because markets are manipulated. And nothing wrong with that. They want to make sure that they say the plunge protection team, the one of the branches of the Federal Reserve market stability mechanism group, that there is no massive debilitating crash right before a major holiday weekend, religious or normal. Why? It's simple. You want people over right before the holiday, cry over their cold beers and barbecues, not buy things on the big sale. There's obviously huge economic stimuli, right? All the big sales and stuff that happen over long weekends, and no, so we don't do that. So that was already put in place. That doesn't mean that's a trading strategy, but hey, that's the way it is. And lo and behold, that's exactly what they did. So again, at this point, if you look at the pattern completion, we're almost there. Does that mean that we're going to just create another one of these big crashes? No. Can happen. It's happened quite a bit lately. Seems like the norm. Can't seem to get my pen. Okay. But the levels are already in place. So from a chart reading perspective, as I'm walking people through different charts and different alerts and stuff like that, is the first drop, it's pretty, this is the way you read it. Here is a green line. So that was the breakout. So it's going to find some support at the breakout. This is a rising wedge or pennant, whatever they call it. I call it rising wedge right there. Rising wedges generally, I wish I had the pen. Hold on. I think I got it. No, they won't let me write on this. Why? Hold on. It's extremely strange. Because I was going to show you guys. I have the pen. Give me 1 second. So far, everything that I'm explaining, and I'm explaining in broader terms here, then we're going to get into some specifics on actual trade management stuff, is making sense, correct? Paul?
Yes.
Scott? Okay. Yeah, I just want to make sure that it's worth your time. So bottom line.
Absolutely.
Okay. So I can't seem to get the pen, so I'll leave it there. So anyway, so now that it's here.
This is Paul.
Yes, Paul.
So my trouble is, I have a day job, and some of your stuff is obviously, for fast, responsive traders. And I noticed your swing trades. You have good swing trades. It's just a little harder to glean which swing trade, how to deal with the swing trades in between all the other information.
Go ahead.
and that's my trouble. Is like I guess I need
Okay.
to know what it's more of the Twitter feeds that I need to understand. Okay, so you pick the swing trades, you follow the swing trades.
Okay, so here's the thing here. What you're saying is not uncommon. I've heard this from many people, and I've helped many people on this. This is the simplest way I can explain it. Whatever stock that you're sitting on a swing trade, you've obviously the chart's been delivered on it, correct?
Yeah, you put out
Exactly.
charts. Yeah.
Okay. So bottom line is, if it's a swing trade and it's going to get, because 90% plus, no question about it, my swing trades get there. Now on the way to getting there, you're going to get big volatility moves, candles. What you're doing, just like many other people, and it's no fault, this is just things that people do, is they're freaking out on every single little red candle that comes along the way, whether it's intraday or whether it's intra-week. So you're not really sticking with the swing. What you're doing is you are doing you are not really focusing on the overall picture that's been presented at the onset of that swing trade. You are basically going ahead and being a total captive of the price movements during the day of that particular trade. So what's
No,
happening is,
I followed MRO right off the beginning,
okay,
and then for a while
let me pick up on MRO. Let me pick up on MRO. MRO is a pure oil dependent stock. So when you're looking at if you're going to trade MRO, you got to keep one eye on oil. If oil is down $3 the next day, there is no way in the world you're going to get there. So you're picking an example of a stock, rightfully so, which is a swing trade, but it was never, it's lottos. So you're basically, if you are going to play MRO, then you need to basically keep one eye on my CL charts, which is basically oil futures, because regardless of what that technical pattern is on MRO, it ain't gonna go the way it's gonna go if oil it's doing wild swings. You look at swings on. Let me throw this one. Show this as a prime example. Couple of small biotech IPOs that came public at $8, $15. Okay, and I have mentioned to people, those are real swing trades. MRO is not MRO is an oil trade. We did very well in MRO the first two times. Then we got caught into MRO the third time. You cannot use MRO, marathon oil. The key word is oil. You're going to play the marathon oil thing. You got to stick with that baby for a while. At this point, I'm piling into MRO. Why? Because it's an all-time low. It went to $10.55. What was it, 2 days ago? And now it's starting to move. But the difference between MRO and other multiple swing trades which have worked is that is purely dependent on oil. And that is the God honest truth. And we can't change that fact.
Okay, is Chipotle a swing trade then?
Absolutely for me. Absolutely for me. I'm going to keep on the case of Chipotle. You have, I'm sure, looked at the charts, correct, on Chipotle? Yeah. Okay, good.
Yeah.
Here is my thing here. This is the reality of the business. Chipotle, technically speaking, 1 second here. And good questions in your part. Hold on. So let me pull up Chipotle. And I show Chipotle mostly. Oh, this is great. Okay, this is nice. So here's Chipotle's chart. From a technical standpoint, Paul, it's a beauty. So I'm going to give you the bullish part and the bearish part. And Scott, I want you to hear this too. So there's a couple of things going on with Chipotle. From a technical standpoint, the one of the most powerful and the easiest tools that I follow or look at is the stochastics. The full stochastics on Chipotle are just ramping higher. All right? Ramping higher. Not fully overbought yet. The way you get overbought, and you guys use Thinkorswim, is when the percentage K line, that's the orange line, or whatever color you guys have, gets above 80. That's when you know things are really overbought. Both these lines, I hate it. I don't know why they wouldn't give access to that thing. Both these lines have to get into the overbought zone. Okay? So that's number one. So at this point, we just have a crossover, very bullish, and from a technical perspective, not overbought yet. Understood, both of you guys?
Yep.
Okay.
Yes.
Yeah, that
So-
makes sense.
okay,
On
good.
the day chart.
Exactly. It doesn't get.
What time frame is most of the swing trades?
I use the 4-hour and the daily.
Okay.
What is the time frame? Don't ask me. I mean, the swing trade time frame. Some swing trades will be weeks. Some of these biotechs took 2 weeks.
Okay.
Okay. There is no. You see, this is another thing that one has to completely mentally calibrate. All these things that you think, the myths about the market that we all kind of knew years ago, they don't matter anymore. So these specific times and this and that don't matter. Why? Because before humans controlled the market, they don't anymore. It's a fact. So we have to change to the new paradigm, and this is not a speech, it's a fact. So the time frames are very compressed. When things start to move, just the way we saw on the form of the market, they tend to happen rather fast and furious because the machines will either push it to one side or another. So it could, what do you call, the ramp ups on techs, biotechs, even the Chipotle type of companies. We could in the old days say, okay, this is a 4-week play or a 3-week play. Now it could be a couple of days, or it could be an hour on some blockbuster news that comes out, and boom, the stock jumps 30 points. So this is just sort of giving you the reality of what this. But generally speaking, a swing play should last anywhere from a week to 2 weeks, as long as it hasn't breached those targets that we talk about. Because if those targets are breached, that obviously you need to take the profits, or at least stick, or do whatever you need to do. So let me explain some very important things here. 1 second. So here we're not overbought, so we're good with that. We're good with the technical aspect of it in the simplest form. We like the fact that there's a lot of volume. I picked up the stock all the way down here, and there was a lot of slipping and sliding going on. Okay, a lot of slipping and sliding going on. Hold up for 1 second, guys. All right, and this is where one has to respect the fact that things change. Things never change permanently. They just change temporarily, and that's called volatility. So from a volatility standpoint, from this level, for example, the stock's at 296. Right now, it's at 321. Looking at the bigger picture, it's not even a real move. But what we like is the fact that there's multiple volume. The volume candles are all green. And 1 second. Okay. And there's consistent buying going on here. You can see that clearly, right? Yes, guys?
Yes.
Okay, good. So right there, that's a positive. Now, is this the start of something? I don't really care whether it's the start of something or not, because people are expecting Chipotle, some people. Because remember one thing, the sentiment on Chipotle, other than 1 or 2 analysts, is extremely bearish.
Mhm.
And generally speaking, those bearish sentiment translates into big, fat short squeezes, generally speaking, on these type of stocks. Now,
That sounds good to me.
let me just I'll explain both the upside and the downside. So bottom line is that so that's good. Now Chipotle also is unfortunately subject to news flashes, aka some customer, the sick customer on the, not E. coli. E. coli is the serious stuff, but on some, minor bacteria thing, or a rat falling off the roof, these kind of black swan events. So we have to be cognizant of that, because it's kind of emotional, driven like that. Okay. What we like from perspective, and this one doesn't have the Fibonacci retracements on it, but I'm going to add it to it in a second, is this is a plus, this is a plus. There's one analyst who basically explained her case very clearly. I guess she's pretty well respected on Wall Street. I didn't know who she was, but I saw her. We were buying prior to her, but it looks, she made it very strong point on the multiple side and this and that on why the stock is a buy. She said it could be 70% from her. If that's the case, us Chipotle holders are going to basically doing a monkey dance, right? 70% from here means the stock's going to be up $210. But obviously, she doesn't mean tomorrow. I mean, that's a long term forecast. Even though that's a pretty heavy duty. 1 second, where is it? That's the weekly. Okay. That's a very heavy duty call. So a couple of things on a technical basis, which I'm following. Okay. And this is just one of the charts, as you know, I follow. So here, this line here, which is your 5-day moving average, is primarily what traders are looking at as to whether it can be supported higher, whether it can be supported higher. What I would so in other words, this has now turned. Now this tried to turn here, but if you notice, it was quite flattish. See that? Here it seems like, and this is a daily chart, so it's a real swing picture that we're looking at. We're not looking at hourly charts and stuff like that. $2 up, $2 down. We're looking at it on a daily. So this one's moving higher, curving higher. So that's a little hockey stick pattern going on. We like that. The second thing that we like here, where on a short-term basis, I think the stock can go towards the 330, 340 level, because that was the reason I drew this line here, is because it tried to find support here and then broke down. And that was back on early August. I'm not sure when the rat incident was. I think it was there, but whichever the case, in August, this was the second, hopefully the final leg of the ratchet down. Saying all that, it's crossed over the blue line here, the 20-day moving average, old classic technical stuff, which is a positive. A lot of traditional technical analysts take these things into account. Oh, it crossed over the 20-day moving average. The 5-day moving average, which is really used by me, a lot of people use the 9-day moving average. I like using the 5, is a plus. Now, in the meantime, the stock is heading now, in my opinion, to retest. Remember, these two fat lines, which are the granddaddy of trends, the 50-day moving average and the 34, are still sloping down like the Swiss ski slope, right? Or somewhere up in Maine. So bottom line is that at these levels, once it hits that, we're going to take some, we're going to be very cautious. At that point, we're going to take profits. And if it hits that, it's still going to be fantastic, because you're talking about, 12 points from here, right? So this is not a point to get excited on from my technical analysis, because this is a point of massive resistance. Now, if it crosses over the 34-day moving average, I showed this repeatedly on multiple trades alerts that I put across, include the Russell 2000. Okay, once it crosses over the 34, the real hardcore shorts start to panic. They start to panic, because at that point, if they were short, let's say here, right? So they have a lot of profits here. Maybe they took a little bit, but they left most of it there because they think Chipotle is going to be like $150 stock, whatever. So at that point, the real short squeeze emanates. This happens to all stocks and markets too. That's over the 340 level. And when that short squeeze comes, you see that big fat candle. And we have seen on multiple stocks that we have traded over the past couple of months. Big fat candle going towards the 50-day moving average, and that's 355.
Speaking of those of the candle on those big fat candles you're talking, is that one of them is like a Mariposa candle?
Okay, that's it. To be honest with you, I know the term. I don't understand it. Okay. I'll be honest with you. But Mariposa, you're absolutely correct. When it comes to candlestick dynamics, I kind of stick to the simple stuff. But what you're saying is correct. I know what a Mariposa is, but I guess that's what they call it, right? One of those big fat bullish. I call it bullish fat engulfing. And because I don't have access to the penny, it shoots up like that, and it's happened to multiple stocks across the board. Many, especially in biotechs, you see that quite often because these are all news driven, right? So all that is good. So these are so when you look at it from a daily perspective, Paul, you see that it looks very small. Like, hey, it doesn't take much to go to 331. Now, if the 5 moving average here, I'm giving you the bullish picture, then I'm going to give you the cautionary picture. So if the 5 moving average now crosses over the yellow line, crosses over this blue, bingo, you got the first real technical buy signal. Okay? And that would be the crossover of the 5 over the blue line, which is the 20. At that point, there's a damn good shot that we're going to basically go above the 34. That's if that crossover happens. We are very close. We are very close. Now remember one thing: institutional guys and the ones some of the institutions who are short, they're the first ones who are covering. Remember, shorts are the smartest. If some of the shorts were smart, they're the ones who cover always at the bottom. The longs come in after they see validation. What my methodology is to follow the shorts when they cover off certain buying distressed property, which is what shows up here from this level. So here it's getting, it's getting overbought. Now overbought doesn't mean it's going to crash and burn, but it might mean, just so you guys understand, what it might mean is, and of course I'll be letting people know that two things can happen. One, it gets overbought and then the line starts moving sideways. In other words, the full stochastic remains above 80 and continues to have relative strength above 80. That shows continued strength. That's when you have these huge rallies. This happened back in March. The stock went from 400 to 500. Okay, or 400 to almost 500, 100 points. And you notice that the movement started down here, very similar to here, to be honest with you, and nobody noticed. Everybody started noticing probably when it was halfway up. We traded a bunch of that at that time, so a good 100 points was had, but it took a month. So if somebody's watching it like a hawk every single minute, they'll probably be out of the trade. But it took a month, but it got there. And all we followed was basically this the full stochastics on the daily, keeping on climbing, just the way it's climbing, and we're sticking to the trade. Are we taking some staggered profits along the way? Absolutely. Are we cost averaging down on a day? It's down $3 or $4 because after all, it's a $300 stock. What's $3, right? So $3 or $4, absolutely yes. So the essence of a swing trade, Paul, is that you need to manage that trade. You need to keep it in the cradle. And if there are minor swings intraday, as long as the trend is not breaking, both on the technical, external, and the internal, then you stick with it by buying a little bit more on the downside, lowering your cost average and such. Now, one of the things I didn't do that I did with Chipotle, because I had a strong conviction, and I hope I'm right on that. It's a game of no guarantees, but is I asked people to buy the 320 and the 340 when the stock was down in the 300s. So in other words, I was buying it 20 to 40 points outside the money. I generally don't do that. Okay? I generally don't do that. But I did that for two reasons. One, if you look at the 340s, they're freaking 60 cents and 70 cents. I can.
That's what I picked. That's what I picked up was
340s. 60. Yeah. So bottom line is I have mostly 340s. I'm with you on this. So the bottom line is that even if it goes to 30 cents, I will lump in and buy more based what I see and alert you guys based what I see in the chart. If the chart is not broken, and I've done this many times on other stocks, is going to 340 or close to 331, those 60-cent things will be at $5. That's what you call a real bang for your buck, just the way we got on a whole bunch of things like, on US Steel, Bank of America, those cheap ones that really go nuts. So bottom line is that's why I said, you know what? Chipotle calls in general are not necessarily cheap. They're not very expensive, but they're not cheap. If you want to buy close to the money, they cost $3, $4, $5, right? So right. The point is how many, it doesn't make sense to me to put in 10 contracts at $5,000 and keep on ramping up. By the time all said and done, I'm going to have $15,000 on a Chipotle trade? No, I'm not going to do that. So I'd rather buy the cheap ones where I can ramp up to, from a volume standpoint, have maybe 100 of them or 50 of them at 60 cents, 70 cents and sell it, like we've done that, not very often, but quite often, and sell them at $2, $3. So a bang for the buck. So I am looking for that move. Now let's stick to this for a second here because this is important. So these things are going positive. We need that crossover. I'd love that. I love the candle dynamics here, that it is creating a pattern, which is nice. It still doesn't have what I'm really looking for, which is a big fat bullish engulfing that juts over the 335 mark and over the 34 moving average. Then I'm going to go and add more, and that's another day session. It's called momentum trading, where you basically chase the candles, and in these type of market, it happens a lot. You chase the candles, and then it's just very profitable stuff. So we don't have that yet. I told you that the best case scenario is we're going to come to the 50-day moving average, and that's going to be massive resistance. This is pretty massive resistance too. It cleared out the 20-day moving average without too much effort, which is nice. So we shall see. Here's the bearish picture. Not rats falling off over our head while we're eating, there is wish I had access to the pen. Let me see what's going on. That is very, very strange. I have this. Just give me a second. I'm just trying to figure out what.
You having trouble with a toss pen?
I'm having trouble with the GoToMeeting.
Oh.
Yeah.
Okay.
Because But anyway, just follow me on this. Yeah, I'm not getting the color, normally like I do. So this pattern here, from a technical standpoint, is still, guys, a bear flag. Okay, a bear flag is when basically, if you look at a bear flag, a bull flag is something goes up, then creates a flag. I've shown many bull flags, and then it breaks out. This, gentlemen, are still a bear flag. So we have to be careful on that part, and I'm watching it very carefully, guys. Okay. Now, what does a bear flag generally do? A bear flag basically causes a mini short covering. New buyers come in, and then the stock maybe moves up a little bit more, and then all of a sudden falls. Okay. So I'm going to be very much on the alert on seeing whether or not these moving averages are going to lift it higher, or whether or not this is a bear flag. Okay, so the bear flag is right there like that, and a bear flag can break down. So we have to be, I'll certainly be keeping a very, very close eye on that. Now, if the bear flag does break down, it's not the end of the world from a swing trade perspective. We have to manage our current trades, obviously, quickly. But from a swing trade perspective, and this has happened repeatedly across the board, it creates a W pattern. It comes down, tests the 296 level. In my opinion, the 296 300 level, for the time being, is a solid support for the stock. Not just because of the round numbers, it is solid support. Period. Okay? Barring any other major incidents, that's just investing, all right? We don't know. Barring them saying, oh, we're just, we're shutting down all the stores, we're not going to serve food anymore, or something crazy, or some sort of other E. coli type of thing, which we have to be cognizant about. It's a food stock after all. So if it does do that, then it's going to create a W pattern, and then it's going to make the real move. We don't know that yet. So you guys, when you look at when you study patterns and listen to my video on the basic chart patterns, very critical. Everyone should know what these patterns are. Then this is what a bear flag looks like. Now, the bear flag can break out, and the real breakout is over 331, 340. At that point, like I said, the big fat squeeze starts all the way up towards the 372 level. So that's really what's being played out. Now, in the meantime, my other Chipotle chart have the Fibonacci retracements. So I'm going to do that quickly. If somebody's doing a real swing trade on this, and there you go. First fib is 343, 23.6 retracement. Generally, over a period of time, maybe a month, month and a half, 2 months, you are going to get towards the 50% retracement level of this 500 to 300 drop, which is 400, 397. There's no magic to it. Will it happen? It will only happen if we can cross over and negate this bear flag. All right, I'm clear on that?
Yep, good stuff.
Okay, now
Yes.
let's look at the weekly. Now, this is all the analysis that comes out. That Chipotle chart is very weird. Let's just put it this way, because there was so much damage done to it, right? It's not a common chart. So we're going to look at the weekly, which I personally haven't seen in a long time. Because don't forget, this was the $800 baby. You know, we used to trade it like monsters. And so let's do this. This is what you call buying real distressed property in the Bronx 30 years ago, and now you have $10 million in your pocket. All right, because some luxury developer went in and put in 60-story skyscrapers. Oh no, not even Bronx, like in Brooklyn. I know you guys been to New York. I know, right across the Brooklyn Bridge or the Manhattan Bridge or the Williamsburg Bridge was like nothing but wasteland. I mean, really, okay, wasteland, wild dogs. And now you can't touch a condo for less than $2 million, and they call it Dumbo, down under the Manhattan Bridge. And so Dumbo, over the last 20 years, it's like, forget about it. It's like, and it's all gentrified. It still looks kind of like rough and tough, but it's like beautiful buildings, a lot of tech companies out there, and great, all kinds of stuff. So is this what we're looking at? I don't know. So bottom line is that when I construct this chart on a weekly, which I'm doing for the first time here, I'm going to draw like this. I just personally like Chipotle for a reason. I don't really, care about the food and stuff that much, It's the fact that the management is a very serious management. And if you know who they are from a fundamental standpoint, these guys were some of the big shots at McDonald's when they founded Chipotle. And Chipotle came a long way. It was what, a $10, $20 stock that went to 800. It's still the best performing stock of the decade. One of the best performing stocks, despite its fall. So the point is that I believe that management is not a bunch of morons, right? They're not a bunch of 20-year-olds, just talking big. They know what they're doing. So got to give something to the management in the meantime. So on the weekly, let's look at some technicals. Forget about what we think. Is right here. This 5-week moving average, the 5-week moving average, and I'm going to reveal something here which is going to make you guys very excited, is the 5-week moving average is 325. So you can clearly see here, Paul and Scott, that if we cross over the 5-week moving average, then we have a shot to get towards, this is on a weekly basis, this is a true swing, okay? As long as we don't break below 290, all this will work. If it breaks below 290, if I see a breakdown, I'm going to short it. Because, there's nothing I can do at that point. At that point, I got to make money on the downside. But shorting a stock that is down from $800 since 2015, in 2 years, is, it's a tough call. So bottom line is that this, once we cross over the 20-week moving average, the yellow line, then you got a fair shot here on a weekly basis. Candle, just the way it did with the stock market. Pattern symmetry means that these candles get replicated, and so we're looking at 360. You guys see that? What I'm seeing? Just
Yes.
pure pattern symmetry. Will it happen? Yes, it will. If we get the Maribozos, or what I call the bullish engulfing reversal candle on the weekly, another one. So this coming week is critical. This coming week, we got to take out the resistance at 323, okay, which is right around the corner. And if you notice, it kissed it. And we want a second candle expansion over this. And that's going to be a lot of money for traders. And those 60 cents, and sitting at 60 cents. So we will have to push them out a little bit more. What do we have? September 15th, right? Paul, those are the September 15th. I mean, I have multiple positions. I can't remember. September 15th are the ones, right?
Yeah.
Good. So
Yes,
we
sir.
have good. I for a minute, because I'm thinking September 8th. I got to push it out. No, September 15th. Good. So it gives us this week, guys, to push and create another green candle, and it's off to the races at least till about that 350, 340, 350 level. And man, that's going to feel sweet. You know that. It's going to feel real sweet, like they say in New York. All right. So bottom line is, on a weekly basis, here's another interesting thing that happened, which I'm seeing for the first time with you guys. Look at these lines here. This enormous 50-week moving averages all the way from 2015. Despite this massive damage of this trend line, which we played a bunch of this move, by the way, in first part of this year. All right, we certainly played that, and despite this massive breakdown, do you see what the 34 and the 50 moving average is doing? And I'm seeing this for the first time. Look at
they're
they're
flattening out.
They're flattening out. Now, what does this mean? Now, average person will say, well, yeah, they're kind of flattening out. Well, this flattening out means a lot. That means that despite this enormous technical and price erosion, the actual 50, the 34, and the 50-week moving averages are not willing to go down. I mean, really crossover down. You understand what I'm saying? Because I would think that with this type of damage, and here was the capitulation volume that day, which was the 17th of July. You see that volume there, guys? This is how you read a real swing chart, like an investment. Like I could be doing a quick 20-minute presentation in front of a massive client or a hedge fund and saying, "Hey guys, you got to buy the crap out of it," because this is the real capitulation volume on a weekly when hell broke loose was actually the 17th. Got it? The 17th of July. That's a month ago. No, that's 2 months ago. Not 2 months ago. Month ago. I mean, I'm thinking we're already September 17th. Oh, so aside from that, this was leftover hits, which did not even come close to this capitulation volume. That capitulation volume comes not because mom and pop own Chipotle. Most traders don't own Chipotle. How much can you own if it's a $400 stock? Like 1,000 shares? Yeah, right. $500,000. I mean, mostly some mom and pops like, okay, I really like Chipotle. I'm going to have a 100 shares. So on a $400 stock, you're looking at $40,000 max on a, let's say, a nice portfolio. So they bailed, and some funds bailed. Fine and good. So that was done with. Then came the buyer, which attempted to buy it, and that didn't work, so they let it go. And now comes this volume expansion is needed. Now looking at the internals, oh boy, this is looking good. See the first signs of a crossover right there. You see that, Paul?
I do. It looks lovely.
So the first signs of a crossover. And with you guys, I'm seeing it for the first time. I haven't seen it Chipotle weekly. All right, first time doing this. I'm happy that I'm doing it. So this is a good thing. Now imagine, this is so deep oversold. Now if this even goes back to the 20 RSI, which is a level of sanity, your Chipotle is going to be basically hitting. If that goes to 20, Chipotle will hit 350, somewhere in between 350 and 400. Okay, that's on a weekly basis. If that crosses over, and no, actually going to 20 RSI, the stock's going to hit 360. It gets overbought by the time it hits this zone, which is 400 to 450. Got it? So that's obviously, we've got to track it. So the other thing to keep in mind here is this flattening 34 and the 50 is a damn good sign. Because honestly, I expected to see a plunging 34 and a 50. So the fact that I didn't see it, for me as a technical trader, me likey what I see. You know what I'm saying? So that's good. So from a swing trade standpoint, that's the picture on this baby. So what we really need this week is another green candle. Even if it's a small one, we need to basically rest above the 5-week moving average, create a green candle. And that will affect all the ranges, the daily, the 1 hour, the 4-hour charts, and that's going to obviously, play upon it. Let me just go back to 1 second here. Let me go back to market stuff, because remember, what your market bias is what's going to determine how you look at a certain trade. And that's the God honest truth. Scott, you know that very well. Paul, you know that too. We all know that. Because if your market bias is bearish, you are going to act in a certain way in managing your trade. Very important. It's simple to say, but it's true. So, like this, that old saying, scared money never wins. Well, if somebody's scared all the time, then they're not going to basically manage their trades right. So what's my job? My job is to look at it in a very, very robotic way and see whether or not it's time to be scared or it's time to be, time to basically still look on the upside. This is your weekly chart, the simplest chart that I'm going to show you. And if you look at the weekly chart, you can clearly see this market at this point wants to go higher than what me and you think. Because this line here, this was the highs on the S&P 500, right? 2490. Well, look what happened. Every single time, and I've shown this chart before, every single time there has been a multi-week consolidation. Everyone's obviously freaked out. Multi-week consolidation. And not in a straight line. That's why I can't short the market in a straight line, It's because you get these big weekly moves, then it stays within the consolidation channel. You guys understand what these consolidation channels are, right? They're pretty obvious.
Yes.
Yes, Paul.
Yeah.
Okay. Yeah, but while they're happening, everyone freaks out, like the demons have landed. I mean, it's just like, and there's nothing wrong with it to freak out, but at least keep an eye on the big picture. So we have multiple consolidation channels which haven't panned out into any massive bear market type of thing. Here we have that blue line. This is what you got to keep on the back of your head. You can pull this up on your TOS too on the weekly. As long as that is edging higher, you're good to go. Because once the 20-day moving average breaks, the next level of support comes in at the 34-day moving average. All these highways or lines that support the underlying market are in good shape. Now, pattern-wise, we are creating a breakout off the consolidation channel, retesting the highs. The market will go to 2,500, by the way, because it's there. And once it gets here, it's a cup and handle where it'll create another small cup. I'm sorry, it's creating a cup towards the 2490, and then it's going to create a small handle, and that handle is going to be a consolidation channel. And we shall see whether after that it wants to bust a move or whether it's going to go. Now, I know what is going on just by looking at this. If you look at the weekly thing, and this has nothing to do with intraday gyrations and stuff, this is to looking out ahead. When you look at the underlying STOs, what does it look like from these levels? What does it look like, guys, to you, first glance?
I think it's bullish.
Yeah, because it's curving up, right? No, I don't want to, so I'm not saying it's going to do this. This only happens off real deep levels, these massive moves. And then the market's over. I'm just simply saying that at this point, it's going to bounce a bit more. That bouncing a bit more means the market can very easily go past 2,500, which is pretty much around the corner. This is on a weekly chart. Now, I can draw a whole bunch of lines on this and all that for now, which I'm not going to do right now, which, in fact, I'll draw one of them, which will tell me exactly from an S&P standpoint. If somebody wants to trade the S&P and buy some out of the money ones and say, I know it's going to get there one with the other, I don't want to look at the screen every day. I have traders who do that. And boy, do they make money. I have a bunch of guys who've been with me for a while, who are very busy with their businesses, and they're like, okay, S&P, show me the long-term charts. They buy it month or two out, and believe me, they don't look at the screens. And it's worked out more often than not based on, what I've shown. And it's just, and they're doing it because one of the biggest drawbacks of active traders, that includes me, is the fact that we are forced to look at these intraday gyrations all the time. So it messes up our swing perspective, let's put it that way, in many cases, because we're just looking at all that noise in traffic and we're losing sight of where we're going. And that happens to me too. Now, saying all that, if I close my eyes, then those type of flash crashes that we incur in the market is obviously it'll be a very dangerous thing if I decided that, okay, I think the market's going higher. See you guys later. Here are some great picks, see you in 3 weeks. Well, it doesn't work like that. So 1 second here. Let me draw this and I'll tell you where I think the market could be by in the next couple of weeks. So, and I've done this so many times and they've been right so many times, up and down. Oh, why do I have this? It's very annoying. And you can see how mathematical it is. I mean, Paul, you're in the automation side, right?
Yeah, factory automation.
There you go. So you're an engineer. So bottom line is, if you do it a pure technical engineering drawing, you can clearly see where the market's going. Where is the market? I believe it's right there. We have entered the lower channel. This is your acceleration channel that started on the weekly from here. And guess what the upper end of the channel is? 2550. It's not that far away. So 2476 is basically 24 plus 50 points is 74 points times, I'm going to use 5 as a factor. You're talking about another 370 points on the Dow Jones. And that will be a intermediate term top in the market before we fall back and retest the lower levels. Not down here, but somewhere in this zone. So basically, you can pen it down somewhere. We got roughly another 370 points on the Dow, and the max level of 2550. Now, will that happen in September? Will it happen in October? I can't really tell you that. But this is a weekly chart, so I'm not saying months. It probably will happen in weeks. And it will happen when when the market's going to be very volatile. Debt ceiling increase, and I'm going to do it. Blah blah blah. And guess what? It gets done. You know it's going to get done. There's too much at stake not to get it done. And boom, the market takes off. Now, before that, it's going to do all kinds of gyrations. It's the same old story. And when it says, okay, got done, boom, you hit that 2550 level. Now, so you guys can do something as an interesting test. Buy one call off the S&P 500 going out to the end of September at 2550 and see what happens as a test. If the SPX is too expensive, buy the SPY. Got it? And see how it happens. And in the meantime, you got enough time left. You'll see that thing gyrate up and down. Don't cost average and stuff. I shouldn't tell you what you need to do, but just as a test, leave it there. Because I have not made some obscene money, and I do pretty well. Okay? Obscene money by not doing certain things that I should be doing on the intermediate swing chart side. Because what happened over the past 2 weeks is not a joke. With this is what's happening is not a joke. This validates the point the markets do not want to break down. That's the reason why and I said this about 10 days ago. And I said it in my video too. $30 billion came out of the stock market. Lovely. Get everybody out of the stock market so we can buy things at will and let it float higher. $30 billion came out of the stock market. That's the highest level since God knows when. Nobody wants to buy stocks. Perfect time to buy stocks. And I'm not making
Hey,
this up. So anyway,
hey,
go ahead.
hey, Frank, I'm looking at the 20 October
On what?
SP on the SPX,
Go ahead, tell me.
the 2550, and so ask is 320 or $3.20, but the open interest is really high. It's kind of interesting, 35,000.
Oh, wow. I didn't even see that. Let me just pull it up. Isn't it?
It's
I
like,
mean, this is good, man. We're actually, let's not tell anybody what we're talking about tonight.
Hey, Frank.
Yes, go ahead, Sir Scott.
Hey, Frank, I'm going to have to leave in about a minute or two because I
No
got to
problem,
head
because
out.
let's just show you this stuff, that thing, and then we're gonna wrap up because
Perfect.
1 second, sir. Let me just detach. What the hell? Okay, got it. So, what the hell happened here? Okay, I'm looking at it myself. You're saying the 20th October, right?
yeah, 20 October, 2550s.
Yeah, I'm looking at it quickly myself. So Scott, just letting you that, okay, 2550s. Holy cow. Let me see. 2550. No, I have the 2000s. There's a lot of open interest on the 2000 calls. Like, who the hell buy? Oh, that's probably a hedge. 2550. Yeah, 35,000 contracts. We're good to go, guys. We
Yeah,
don't need to trade, all right? Let's do that. Because one last thing I'll tell you, in between our trading and stuff that we do, and it's all good and stuff, but the biggest thing is that don't micro focus on things despite my tweets, and I'm giving you solid suggestions. There are active traders who want to basically close their books at the end of each day. Fine and good. Fine and good. But in the meantime, you look at something like that, buy yourself time, don't over diversify, and and especially when it comes to the oil stocks and stuff, those are held hostage to obviously the movement in oil. But a couple of my biotechs and stuff like Juno and things like that, buying a few calls at $2.30 and 40, they have paid very handsomely. Kite, I didn't have calls, I had common. It was a huge win. But I've been trading that stock for a while now. Bluebird Bio, same story. And then, of course, you have those individual stocks. Now, one last thing. When you're trading the Teslas, the Apple's good. Apple's more steady. But when you're trading the Teslas, the Googles, the Amazon, just keep in mind that you have to be active with those. Those things move around like monkeys on a hot tin roof. $15 up, $15 down. So they do have a trend, but they're a lot more active because the hedge funds are trading them. So keeping that in mind, I can be telling people to buy Amazon 1200 calls because honestly, I don't even know if it's going to go to 1,000. In the meantime, we did very decently on the 970 calls when the stock was not lying in the gutter at 930. So just keep that in mind. Every single options or trade has a different characteristic. And if you have any specific questions on that, ask me. I'll be happy to answer that. Fair enough?
Yes.
yeah,
Okay. So Paul, you're good?
I'm good.
Awesome. And Paul, I'm going to call you. Yeah. Scott, you can drop off.
Okay. Thank you. Have a good weekend, guys.
Thank you.
You too.
1 second, Paul. Okay, cool. Anyway, just wanted to pass it on to you. I would love you to, welcome back to the family. So go ahead and re-enroll back so you stay connected. And there's going to be a whole bunch of other stuff and you are more than welcome to sit in on I don't mind doing one of these quick type of sessions every now and then, and you don't need to sign up for it. It's just something I want to help you and guys like Scott, and there's a few other guys like that who can sit in. We can do an early morning Saturday, that type of stuff, or whenever it's convenient. And these things are going to be extremely helpful. So is that all right?
Yeah, sounds good. So I just go back to your website and sign back up.
You just go back to the website, go back and Yes, and re-enroll back as the gold. Now I have you. The thing is that I have you. What I did was I manually went in and activated it. This is what you need to do. Um, Go ahead and yeah, go ahead and sign up. If there's any issues, text and let me know. So you're all set to go by Tuesday. Okay. And because right now you're manually active, so you can basically go in, you have full access to anything, and you go upgrade gold, that type of stuff. All right.
Okay, I think
And,
so. I'll
and
check it out. See what
yeah,
see what
exactly.
the website's saying.
Well, the website, yeah, it's just normal enrollment, and that's a very interesting thing that you detected based on the charts. The 2550, that's one heck of a thing. That's 20th October. That's generally speaking the last of the big volatility moves before the market takes that run um, towards November December period. You know what I'm saying? Generally speaking,
Yeah,
by
and
by the 20th. Yeah, very interesting.
I like this part of the swing trading education. That was good, Frank.
Well, there's quite a bit more. So when we do the next one,
I'm sure.
I'll be teaching you guys quite a bit more because things I've learned on my own because nobody sat me down and said okay, but I learned all the basics from the right people. But when it comes to actually applying it to the real world, that's all self-taught. So that's pretty much what you guys will be learning. All right. So go ahead and sign back up. Have a great weekend. Give my best to your wife, and I shall be seeing you. All right.
All right, thank you.
Anytime, sir. Bye bye.